Welcome back. It's turning out to be a very quiet session, a session of consolidation. Frontline indices down a bit, hardly, but moving in a tight band. The Nifty is holding on to 24,300. It's all about individual stocks. Deepak Shenoy from Capitalmind is now with us to talk about the market fundamentals. Deepak, Capitalmind, your company has come up with an interesting analysis where you've analyzed the price action, the earnings action of small cap stocks, the indices, since COVID. Take us through your analysis.
So thanks, Reema. I think one of the things that we've been doing in Capitalmind is just trying to figure out the eternal question now is, are small caps overvalued because their P reaches 30 or ranges of that kind. One of the problems is that because the market has run up in the last year or the last couple of years, we feel that this this run up is extreme and there are lots of stocks that are way too expensive and so on. So to put that in context, you have to kind of take it in both ways. First, try to get an unbiased analysis. One of the ideas would be, is this P ratio of around 30 plus? And you can't take the NSE small cap 250. You have to actually take the BSE one because the NSE changed their earnings reporting format in 2022, I think, or 2020. But so you can't get a good P ratio kind of analysis of the past. But if you do that with the BSE 250, you find that today's ranges, while relatively a little bit higher than the average, are not meaningfully at an extreme. We've seen as much as 50 times and even 80 times plus in the past. So right now at 30 times earnings, it is not meaningfully high enough to say that it is way overvalued. The second one is that apart from the current year, the small cap earnings growth has actually been quite good. Past 5 years, if you look at it, they have actually grown their earnings 3x. And the small cap index is about 3.5 or 4x nearly. So in a sense that the market has actually gone up along with earnings. So in that sense, the overvaluation is not as extreme as you might think. So this part of the analysis, if you look at, provides a favorable picture. But there is an unfavorable picture as well, but because if you look at the past, and although P's have been higher, at any time when you buy the small caps, when their aggregate P is more than 30, the next 6-month returns tend to be negative for the most part. So that is the other side of this equation. So there may be pockets of temporary overvaluation, but I don't think it's meaningfully high, meaningfully negative for us in the longer term. I just feel that it's not as overvalued as one might think it is.
Oh, okay. So in that case, Deepak, what are you suggesting your clients when it comes to small caps? Because there's been a lot of caution, but we don't see that in mutual fund flows. They've ebbed, of course, from highs, but they are still steady on a monthly basis.
Yes, I think small cap indexes continue to be okay. It's not like, for instance, they've taken more of a hit this month than the Nifty has. But in general, we've seen that the earnings profile has not been, battered or been seriously negative. We've just seen earnings growth coming from like a 20-25% down to, I think, a little bit flat right now. So 1 year return right now on the small cap index is about 64%. But the the earnings growth itself is about flat or minus 3% or something like that. This might mean one thing. There are pockets of the market which are not growing, which are getting very high valuation. One of them, perhaps, to give you an example, there was a result today of IRFC. IRFC is valued at a very rich valuation, 37 times earnings, but earnings growth is relatively small because it lends to pretty much one customer. So at that point, you might wonder whether that is a company that on a fundamental basis may not be able to live up to expectations. But at the same time, you have companies like, and we own some of this, like say Keynes Semiconductors, where you had earnings growth of 50+%. Although it is valued very richly, they're actually showing reasonable amounts of earnings growth and a market that seems to provide more opportunities for future earnings growth as well in those contexts. So I think it's going to be stock specific in small caps. You got to pay for growth. You don't pay for no growth. And I think we made that mistake in FMCG, in MNC FMCG a few years back. We paid a lot of money, a lot of high P ratios but their growth came up to be 10-15%. Look at what their prices have done in the last 3 or 4 years. Although we are in a bull market, they are lagging the market quite considerably. So we should be careful to not overpay for low growth. You can pay for growth, but you should definitely watch that growth is actually happening or not.
Deepak, what are the constituents of BSE 250? We know, like the index, the Nifty is over-indexed to financial. So for BSE 250, the data that you've analyzed, can you give us a sectoral color in terms of contribution? Because if someone just buys the index, they should know the exposure that they're getting into. Because everyone says that, well, there are very few, exposure to railways, manufacturing, defense can only be bought by these mid and small cap. So, tell us, how the individual segregate the BSE 250 for us in terms of sectors, in terms of exposure, and which pockets of those have done well in the last year in terms of earnings.
So the indexes change every 6 months anyways, because what happens every 6 months is the number of stocks, some of the small caps will become mid caps, some of the small caps will become micro caps. So there'll be a shift in this on a regular basis. So even therefore, the sectoral mix will kind of shift across. So I think if I will just look at, I don't think I have the numbers per se right now, but you've got a lot of companies in smaller end manufacturing, of course, some railways and some defense as well, which started off as small caps. Some of these were small caps and have become large caps. So like a Mazgaon Dock at some point was in one of the small cap indexes, but it's now a larger cap stock. So this index thing would change. But right now, even here, there's about 20% of financials. Capital goods is about maybe 15%. I think healthcare is about 10%. And auto components are about 6%. These are the largest. There's some chemicals. And it's a very well represented series of stocks. So you actually have enough from real estate. For instance, Nifty has almost no real estate, but other than indirect exposure. So here you have direct real estate about 2.5%. You have media and entertainment, which does not almost, other than ZZ, which was in the Nifty a long back, you had no media player at all. So now you don't, other than the pockets of Reliance. There's a much bigger, like a 1.5% in the BSE small cap 250 in that. So it's more diversified as an index, but it's still relatively heavy on financials in the sense of 20% is financials versus Nifty, I think, is what 40 or 45% financials.
Very quickly, any stocks that you would like to draw attention to where the PE re-rating has been considerable, but earnings have not kept pace? You gave one example, but 2-3 others which come to your mind, or a few others?
Good question. I think right now, for instance, this quarter has been pretty bad for a lot of capital goods companies, simply because orders don't come in an election quarter. So you get very low visibility, you don't have much on hand and so on. But you can see some of the chemical companies have relatively low growth. Part of it is Chinese influence, part of it is the cycle itself. I think we've seen some of the steel players also have higher players. I'm not going to take a lot of names here because, they're not, I don't have the exact numbers in front of me. But the commodities players, at least in steel and steel tubes and so on, where the PE has been higher and growth has been slowing, those are the areas where you might find a little bit of extremes in valuation. There is a promise, for instance, in Inox Wind. The promise is there of potentially large future earnings. So in some of those cases, the current earnings may not necessarily determine what is there in the future. But I think a number of stocks over here, you'll find that, you'll have to map them. I don't have the exact numbers on, but I think commodities, chemicals, specifically, and perhaps in some small cap IT names as well, you do have lower growth and extremely high, earnings multiples that are being given. So I'd just be wary of that.
Okay, thank you very much for that. We will slip into a very short break. We'll come back and talk about Apollo Hospitals, Hero Motor Corp, and DOMS.